I'm really glad that we're all here. We've got some really unique content that we want to give you today. I just want to start with a quick introduction about what Equi is and who we are before we get into the good content. So for everybody out there who's meeting us for the first time, hello, we are Equi. We are the first digital family office. So we turn you into your own family office or endowment, depending on how you want to look at it, in just a few clicks. So you can think about us almost as a cheat code for helping you invest like the most sophisticated investors who are out there. You don't have to have 100, 500, $1 billion. We'll do a lot of that heavy lifting for you, and we help you get into the world of alts by giving you a diversified basket of the best private market investments. That was a mouthful right there. Just a little bit more about us. So we've already got a 3,000 person waiting list. We've had substantial outperformance versus the S&P 500 and benchmarks this year. This is something Itay can tell you a lot more about. And we've built a world-class team with some really unique tech. If you're interested, you can always visit us. Just go to equi.com. You can apply in the upper right-hand corner. Or you can just email us, founders@equi.com. All right, that was the first part of the spiel. Okay, now let's get into the introductions. I want to first introduce you to my co-founder, Itay. He is an incredible investor. Started his career over at UBS, where he saw how billionaires invested their portfolios, and he was doing that in Beverly Hills. So quite a few of those type of people hanging out there. He's also built his own successful RIA where he was managing over $100 million, and he ran a quantitative hedge fund with almost zero correlation to the market. And it was averaging almost 20% a year while he did that. And then he sold it. And now he's back doing it again, uncorrelated strategies here at Equi alongside yours truly. Itay, do you want to quickly just say hello to everybody? And did I get that all right, or did I misrepresent any facts in the process?
No, thank you so much. That was pretty accurate. What you failed to mention is that we got together after you had your exit from Spot Hero. Helped, I don't know how many millions of drivers find their parking spots, and we basically came across the same problem, that we had some level of liquidity. I know it's a champagne problem, but still, we had some level of liquidity, and none of us knew really how to invest it. I mean, we did know, but we didn't want to invest it in the way that existed. And there was no solution for people like us. So we just decided to do it ourselves, partnered up and created a, I would say, quasi multifamily empire alongside with another RIA and investments across a diversified landscape. So that was really the birth story of what Equi became.
Yeah. So we today are trying to basically help everybody else invest like one of these really sophisticated entities. And, we're doing this right alongside all of our customers. So with that said, Itay and the champagne problems, I promise I'm going to steal that from you one day, because first time I heard it and I really like it a lot. But with that said, let's talk about some markets. Are you ready? I know you prepared some good content. What are we gonna talk about today?
All right, so we'll do a little bit of a market update and what's been going on over the last 3 weeks since our last call. So I'm going to share my screen. Let me know if you're able to see it.
Yes, I can, and I love the updated collateral right there. It looks a lot more. It's looking more professional each time.
Equi making elite investing accessible. So today is August 1st. 2022. And I feel like recently we've been having this discussion almost every market call, asking the same question: is this just another bear market rally? And every time we've been saying yes, and every time the market has been rolling over to make those new lows. And today, the question is, the answer is not necessarily going to be a yes like last time. I think we had this discussion in July, and we said most likely yes, but we did not make a new low. We almost made a new low and moved up again. The answer this time is more of a maybe than an absolute yes, and we'll dissect that in a little bit. So far we've had 4 of these rallies since the market topped really at the first day of 2022, or you can even say in the end of December 2021. And we've had 4 rallies thus far: 9%, 13%, 10%, 14%. But remember, when you are down 25%, as the S&P was between January and June, 14% doesn't get you as far as it used to, because you need to make 33% to get back to break even. It's just the way math works.
Which is one of the key points that we always talk about, which is that the losses and compounding losses are harder to get over.
That's why a 14% rally on the chart only brings you up here, given where you were. And that's really why that is. It's just the way math works. So what inspired this rally over the past week? So last week was, I believe, the best week since 2020. And the month of July was a very positive month for the S&P 500. I think it was up close to 9%. So it's truly incredible month on the upside. And one of the things that really brought it about, the rally during Wednesday, Thursday, and Friday of last week. Wednesday was the FOMC Fed decision to raise interest rates by 0.75% that caused this massive spike in the market. The following day, we found out that we are in a recession, even though I don't know what they're doing with the definition of that. Last time I checked, it was 2 consecutive quarters of declining GDP, but it may or may not be the case anymore. Nonetheless, we've had a negative GDP print of negative 0.9%, and the market rallied. So everybody's wondering, why is the market rallying so much, given that, quote, negative, double whammy negative, right? Negative GDP, Fed raising rates. Well, a couple things. First, it was pretty much expected and baked in because everybody knew it was coming. So participants were already ready for it. But the second one is that the market is really not believing the Fed whatsoever. What do I mean by that? So what you're seeing here in the green is what's called the dot plot, which each member of the FOMC, the Federal Open Market Committee, gets a vote of where they believe interest rates should be in a certain time frame. So here's 2022, and the range really is between 3.25%, almost to 4%. And then in 2023, it's from a low range of 3.5%, potentially all the way to 4.5%. So the Fed is saying, we're very hawkish. We're going to keep raising interest rates into 23. What you're seeing in white is the Fed funds futures, or market pricing of interest rates, which is now pricing in major rate cuts into 23 and 24, meaning that the market does not believe the Fed whatsoever, and actually thinking the Fed will stop raising interest rates this year and actually start cutting them next year. And some of the Fed speech during the last meeting, when they're talking about softening economic outlook, actually made the market believe that, and really exploded on the upside.
So Itay, let's say this gap gets too big between the Fed funds futures and where the FOMC dot plot is. How can the market actually force the Fed's hand to kind of capitulate on rates? What would kind of lead to that chain of events?
I mean, if the market mispricing is that large, that you could see some real market damage if the Fed still follows the dot plot. It may coerce the Fed to not do it. However, it still remains to be seen whether or not the Fed will try to still stop the market. And I think a lot of it depends on the inflation outlook. But as of right now, the market's kind of calling out the Fed, saying we're just straight out, we don't believe you, which I think is just mind-boggling.
It's very interesting.
So you can see this, not only that you had a large move, this move after Jay Powell, so even Bloomberg mentions believing they heard a dovish tilt from Jay Powell, which may or may not have happened. He was just talking about weakening economic outlook. It actually spiked the largest post-meeting rally ever, which is just unbelievable. And then we get the GDP, which was expected to coming in at 0.4, but came at negative 0.9. So now you have 2 negative consecutive quarters. And if you believe the Fed is going to be dovish, you're going back to the whole bad news is good news cycle, where you get negative economic news, which means you're going to get a more dovish Fed, which means you're going to get more liquidity in the future, which means higher stock prices, right? We've been in that. But
what about the looming 9.1% inflation rate?
Right. That's exactly the kind of trillion pound gorilla. And it seems the market believes at this point inflation has peaked as well. I mean, inflation expectations are falling. We've seen falling commodity prices and tightening financial conditions. So the question is the market really getting ahead of itself, thinking or wanting to believe that this is over, or is it actually over and the Fed is really going to pivot and the market is just smarter? You know, the common knowledge of the market is ahead of the true events potentially by months, as history has proven to be the case. So that's really the question we have to tackle when we're analyzing these things. Let's talk about the bear pain that was experienced recently and why there could be some more room for upside.
What a picture.
You know, a crying bear after a 9% up month. I mean, all the bears should be crying.
Yeah, I think you deserve an award for finding that picture.
So sentiment is still very low. And sentiment is known as a contrarian indicator, where why is sentiment a contrarian indicator? So imagine you were bearish on the market, meaning that you're going to sell. And at some point, everybody that's bearish, if everybody is bearish, they're all going to sell. And at some point, you're just going to simply run out of sellers. And when you run out of sellers, the potential for upside increases because all those people that sold previously are sitting in cash are going to need to buy back at some point. Vice versa, when everybody's bullish, you get the opposite effect. So of course, there are many other factors like Fed liquidity and earnings and all these kind of things, but sentiment is definitely an interesting indicator to look at. And it works more on the downside than the upside. Like upside can get extended for longer. Very negative bear sentiment doesn't last that long typically. However, in 2008, for example, it lasted for almost a year. So even though market prices continue to fall, sentiment remained very low for very long. So again, take that with a grain of salt. This is one that's a little interesting when you're looking at global flows in and out of the market. So for the majority of the year, with a few exceptions here, here, and here, there were continuously negative flows out of the markets. And then you can see the cumulative flows in this line right there. And over the last few days, particularly after the Fed, we've seen the largest inflows in 2022. So it seems some players have started to come back into the market.
So this outflow just being selling, and a little bit of buying creeping up now.
Right. It's kind of interesting because in the past, the little bit of buying was a termination event. So that was enough to get everybody to sell into it. And right now, we've seen the strongest buying of the year. So typically, if you have a sustainable move up, you're going to see more buying coming and staying in, which is why this rally, I believe, has lasted longer than previous rallies this year, because you have some real money backing it versus in the past, it was really just short covering.
Cool.
We also have hedge funds that are in a fairly low position. You see this chart goes back to January of 2020. You can see the gross leverage and net leverage of hedge funds. And on a relative basis, you see here in 21, they were between 65 and 75% net leverage position. Right now, the net leverage position is only at 45%. So what that means is that if the market continues to go up, their exposure to that market upside is really low, which will force them to chase the upside and buy, and continue to buy and basically chase the performance. Because imagine the market goes up 20% from here. If they don't have enough exposure, they're going to be drastically underperforming the index. So that's definitely something that can happen.
And on the flip side, if the market keeps going down, would they have to deleverage further?
They're fairly low. They could deleverage somewhat further, but they're at a relative low position. 45% is fairly low.
Okay.
Now, liquidity is still pretty terrible as a factor of rising interest rates and Fed quantitative tightening. You can see here, goes back to around 2013. This is the top of book depth. So what that means is that how many millions of dollars are trading at every S&P 500 tick, a very, very small increment. So you can buy and sell massive amounts of S&P here, $65 million at a single tick. So it's less than a point. And then right now, liquidity is only about $5 million per tick or something along those lines. We've only seen that during crash events or very low liquidity periods, but the entirety of 2022 has seen this. I'm suspecting that's really a factor of the QT.
What does really low liquidity tell you about the markets, and what are the implications for all of us holding the S&P 500 when there is low liquidity?
Yeah, so low liquidity just contributes to higher volatility because it takes less dollars to move the market. So imagine if you're moving $1 billion and you can absorb at $60 million per tick or $5 million per tick. Your $1 billion is going to move the market a lot more when the liquidity is low. But it could be in both ways. So if you're buying $1 billion, you're going to move the market way more on the upside, and you're selling, you're going to move it way more on the downside. But the second thing is that moving around large books, so a big hedge fund that trades billions and billions of dollars is going to have a very difficult time trading in and out quickly. So they're going to, it's just, and that again contributes to volatility. But people forget that that type of liquidity and volatility actually works both ways. So in this scenario, imagine the hedge funds that have a low position decide that it's time to buy because whatever, the Fed pivoted and they really think that QE is coming back. If liquidity stays this low, their buying potentially will move the market a lot more than it would in times where liquidity is plentiful.
Got it.
Okay, and again, positioning is light, not just across hedge funds, but across many, many other types of players. So when you're looking at the volatility control, equity allocation, systematic, CTAs, risk parity, they're all sitting in a relatively low position, which makes sense because the market's been going down for a while and they don't want to have too much exposure, but it just leaves them underexposed in case things turn around. And the biggest one of it all, right? Everybody's worrying about inflation, but what if inflation really is over? So this chart is measuring the M2 growth rate year over year.
M2 being broader money supply.
Correct. The M2 broader money supply, 18 months ahead of CPI. So imagine you're basically taking the M2 data, you're throwing it 18 months into the future, and then you lay out CPI on top of it. So you could really see that that giant spike in M2 money supply has led inflation. We got CPI exactly 18 months after that giant injection in 2020. However, that growth rate is about to take a cliff dive going forward, which could have, if that correlation remains true, could mean that CPI has peaked and is going to fall very quickly.
Got it.
So
Okay.
if you believe that inflation going lower is going to be a positive thing for risk assets, then it means you should be bullish.
Well, are we going to get to talk about the different components of CPI? Because some of that CPI is going to go away, but some of it is here to stay.
It's true, but the thing I think we should talk about that's even more so is whether or not a falling CPI is going to be positive for risk assets. Everybody assumes that that is the case, but I'm going to make the argument that it's not necessarily the case.
Ooh, controversy.
So now let's talk about whether or not the Fed pivot is actually going to be bullish for the markets.
I think this is we got the crying bear and now we're getting this. Itay, are you trying to pull out all the stops on us tonight?
I think this is one of Jay Powell's best.
I think so too. This would be a Twitter meme worthy picture.
So will the Fed pivot really be bullish? And I think this is really a key question here. Let's talk about 1997 to 2002, also known as the tech bust. What you see in blue is the Fed funds rate. It's a little wobbly because it's actually daily. A lot of people don't realize that when you raise interest rates, it's within a 25 basis point range, and it actually fluctuates within that range. So when you're looking at it on a monthly, you see the straight line, but then daily it's a little fluctuating. Never mind, I digress. The red line is the S&P 500. So what's interesting is that the Fed fund rate actually moved up with the S&P 500. So market was moving up as the Fed was hiking, and then the Fed stopped hiking. And as the Fed stopped hiking, because apparently rate increases have a lag effect on earnings and other things, markets start dropping. But as the markets start dropping, the Fed start cutting rates. And guess what happened as the Fed cut rates? Markets fell even more.
Okay, so let's try to unpack this. Is this literally because what would cause this to happen?
So at that point, you were already in a deep recession, and the impacts of raising interest rates came at a lag. Earnings decelerated even more, consumption got hit, unemployment rose, and the Fed cutting rates actually meant that you're already in a recession, and then there was a loss of confidence. And what's interesting is here, the Fed reached the low level of what they were willing to drop it to, and then the markets start recovering after the Fed dropped it to this level. And within about a year or so, the Fed started raising interest rates again. So it's actually, the interest rate cycle could actually be correlated with equities as well. It's not necessarily the case. I know the common wisdom is, well, if the Fed's going to start easing and cutting rates, then that means equities are going to go up, but that's not necessarily the case.
Interesting. So in this case of at least 2001, it's almost the cutting of the rates signaled, hey, this is kind of the end of the party.
That's correct, but not only in 2001, also in 2007, 2008. So 2007, 2008, 2007, right there, market also moves up with the Fed funds rate. Fed funds rate peaks around March 2007. First rate cut comes in around the top, and then there's a total panic at the Fed to cut rates to zero, and market only bottoms when the zero level is hit.
Got it. And then the increase, and then where in this graph does the quantitative easing or the money printing go back into the system?
So that was the first time QE was used, and it actually came in around here. So it came in a few months before the bottom, and that's where QE was introduced for the first time.
Got it. So you're saying, let's say if this QE didn't happen, maybe this red line doesn't kind of go up. Maybe it kind of flatlines a little bit.
Or maybe it doesn't go up as much as it did, or the recovery wasn't as quick. But nonetheless, it is interesting that counterintuitively, a Fed pivot and rate cuts is not necessarily bullish as people may think.
Cool.
There is an exception, the 1970s, the period of stagflation, where you had the oil shocks in 73, and then you had the bear market at 74. During that decade, there was a direct correlation between the Fed funds rate and where the stock market was trading. So what you're seeing here is the equity markets, the Dow Jones, and in this light blue line, this is the Fed funds rate inverted. So basically when it's going lower,
the high points are the low.
Correct.
The high points are actually the low levels.
Correct. Correct. So in the 1970s, we did observe and just a very easy direct correlation, higher rates, lower prices, lower rates, higher prices. It was very easy and very direct.
So which market are we more like? Are we more like the 70s right now, or more like 2001?
Well, if I knew the answer to that question, I would probably be all in levered on whatever direction the Fed funds rate was going at.
We're gonna have to get you some. We're gonna have to get you in front of some of the right people. Okay.
So some of the scary thoughts that if this is 1970s like, this is a comparison between 2022 here in orange and 08. So we know that the direction of the Fed funds rate is going to go straight up for the next few months. So that could mean something closer to what happened in 2008. If 1970s correlations held true, which obviously is, I think it's actually a lower chance than none, because I'm not fully convinced that inflation, I think it's going to be sticky, but I don't know if we're going to really see it at these levels. Second thing is interesting too, is you can compare the VIX of that period with the current VIX. A lot of people have been complaining that the VIX is very low compared to volatility, which is true. Realized volatility has been very high and the market's been gyrating up and down quite a bit, but the VIX is fairly low. I mean, it's only at around 22, but it did the same.
The volatility index, which measures the amount of puts and calls on the greater market, correct?
Right. So options are relatively cheap compared to the real movements that are taking place. Which shouldn't really be the case when you have such a volatile market. But if you overlay where we are today, which is the white, and this is COVID, so it's really this exception. When the world shut down, there was a period of panic. And you compare this current period to 0809, this is really 08, this is 07, 08. It's very similar. And people forget. And we got below 20 VIX in the middle of 08, right before Lehman, right before all these things happened. That was here. But before all that, there was a period of quiet.
And a steady state VIX is about where and what's kind of the low point on the VIX, just so that everybody's frame of reference.
So very, very low periods of VIX are 10. We've seen 9 in 2017. That's pretty abnormally low. Typically you're seeing closer to 15, 16 in normal bull markets, but the long-term average of the VIX is around 20. So being in a bear market, seeing this much volatility and being around 22, 20, 25 is low.
Okay, got it.
Okay, next topic I thought would be quite interesting is the Fed's quantitative tightening process, or as I like to call it, the printer in reverse. And it's having some real impacts on the economy, and we're seeing some implications for it.
I think you should have just gotten a picture of a shredder.
True, true. I was trying to think of a printer going in reverse and couldn't quite find it.
No, it's not bad. It's not bad.
So the Fed's projections on quantitative tightening, from what they laid out when the process was starting, between June and August of 2022, we were talking about $30 billion of Treasury securities and $17.5 billion of mortgage-backed securities and MBSs. Now, from September, which is just a month from now, that's going to double to 60 billion in Treasury securities and 35 billion in MBS. That's a lot.
Is that
so? That's per month.
And how much are we doing? How much has actually been done? They had their target numbers, but how much did they actually do?
Yeah, we'll talk about that in a second, but not as much as you would think. So they have actually fallen short on QT so far, which is not a surprise at all to anybody that's
right.
that knows how these things operate. And it's not as easy as you would think. So when we summarize QT, here's all the QE that happened, by the way. So you can see the Fed's balance sheet going back to 2000 here. And this is Treasuries and this is MBS. So first QEs happen 0809, as we all know. And then the COVID reaction was just stunning, where
let's talk about QE, how money gets in the system. So I'm Jay Powell, I chair the Fed, I print money. You're the federal government, I give you money in exchange for these bonds. You end up eventually repaying me, but this is how money can be printed out of thin air and ends up in circulation. And then the reverse QT of what we're talking about is basically, hey, you have all these bonds or these IOUs where you have to give me back my principal, you the federal government giving me the Fed back money. When this money comes back, in a QT world, rather than it just going onto my balance sheet and staying there, we delete it entirely. So it's like the money doesn't exist. So the federal government collects taxes, does whatever, gives the money back to us, and then we delete it out of the system, correct?
That is exactly how it works. It's as easy as that.
Unbelievable.
Well, what makes it even more unbelievable is during the QE programs, when the Fed was buying Treasury securities, you would be thinking that it's buying Treasury securities from the US Treasury, right?
Yes.
But that was not the case. They were buying it from the likes of JP Morgan and Goldman Sachs and Morgan Stanley, and making them millions and millions of dollars in commissions for facilitating these transactions when there was literally no need for that.
Really? So is this the form of like a bailout and a way to give those banks a little bit of extra liquidity as well?
Yeah, but they did that years into even in 2013 and other years where you're already removed from the financial crisis. So anyway, this is just a little bit of how our system operates. So the Fed actually hit the QE targets with treasuries fairly easily, and the reason is it's holding so many treasuries and so many different maturities that they just let them expire. And as they expire, they get the principal back from the federal government and then they just destroy it. So there's really two ways to do QT, and that is you either let it expire and then you destroy the money, which is what they've been doing, or you just directly sell it. So the Fed has decided that they're only going to do runoff. They're not going to actively sell anything. They're just going to let it expire and then it's destroyed. So those amounts of money have been easy to do with treasuries because there's just so much treasuries. But it hasn't worked as well with mortgage-backed securities. And here you can see the change in the Fed securities this year. By the way, people don't know, but at the beginning of the year, the Fed was still even doing QE. So that rate was even growing at that point, but then it started declining. And as it was declining, now they're both numbers are negative net for the year, but obviously treasuries are much more than MBSs. MBSs are almost flat. And why is that?
I don't know.
It's all about the duration. So if you want to do a runoff, it needs to expire. And then when it expires, you just basically destroy the money. But you can see that the MBS, the mortgage-backed security, the vast majority of what the Fed holds from all is over 10 years in maturity. So if it's not going to mature today, how do you get rid of it? Well, if you understand mortgage-backed securities, you would know that when you have a mortgage, imagine a Fannie Mae, Freddie Mac, and all this kind of stuff. When somebody sells a home that has a loan against it, what happens? The buyer pays the full amount. Maybe the buyer takes a mortgage on his own, and then the lender plus the down payment comes in, and then they basically take out the existing mortgage. When they prepay the existing mortgage, that goes into the MBS as a prepayment, and then that MBS expires. So it may, the loan, think of a mortgage that is 20 years left. Somebody comes in and buys the house after 10 years, there's no more 20-year loan because now it's been paid back.
Correct.
But since the beginning of the year, there's been a big problem because existing home sales are down over 20%. So there's substantially less turnover in the housing market, which means that there's a lot less prepayments that are happening, which means that substantially less MBSs are getting paid back, which creates a problem for the Fed because they literally cannot meet those QT targets with runoff.
Got it. So we're just saying that in a normal prepayment world where people are closing out one loan for another one, they would get their money back and they could get the payment and delete it from the system. But right now we have this place where nobody wants to actually prepay the loan and they have a liquidity issue where they can't even get their money out.
Right. So the only way the Fed is going to be able to do so this is the runoff situation, right? The runoff just means that even though it has more than 10-year maturity, as long as the loan is paid, it's closed. And the only way that can happen is if there's enough turnaround in the housing market and home sales are up. But home sales are down, which I believe the Fed did not account for when they made this plan. Mm-hmm. Which means that the only way to meet the QT targets would be to directly sell the MBSs into the market. But if you sell the MBSs into the market, you would cause a further increase in interest rates, which would cause an even further increase in mortgage rates.
Correct, because they're inversely correlated, the prices and interest rates. So if you flood the market with this type of debt, the interest rate would have to go up and up and up to compensate you for what's available.
Correct. And everything we've seen with the rise of interest rates in housing didn't actually have MBSs sold. This was just a direct impact of the treasury.
The Fed is, you're basically saying Fed's not going to get their QT and not going to get their money out of the MBS market. Fine. So really they're going to only get their QT and their money out of the actual, from the federal government for the bonds and the treasuries they purchased.
Unless they decide to sell MBSs in the market, which I kind of doubt that they will, because they will absolutely crash the housing market.
Yeah, of course, because then the 10-year would spike up and then it would just cause the cascade even further.
Correct. And what we've seen, so right now over the last month or so, mortgage rates did go down from 6%. They ticked 6% for a little bit back to 5.3. And nonetheless, you can see how insane the move up in mortgage rates has been since December of last year. Basically a double, right? And this is not including really any MBS sales. That's the craziest part of it all. So if the Fed did decide to implement the QT targets, it would have an impact on the market. But I believe, as you mentioned, the Fed is unlikely to meet those targets. They're probably going to change them or do something about it, because if they will, it's very likely to crash the housing market that already has a big drop in home sales. What's even more interesting, when you look at the following chart, is in the deep blue, you see home sales, and they've plunged off a cliff with increased interest rates. And then in the light blue, that's the Case-Shiller home price index. And we've had many year correlation that's very tight between sales and price, but price is still pretty high up and sales are down quite a bit.
So why is there this decoupling? Why is there so much of a spread between?
Yeah. So my take on it is that the labor market is still fairly strong and people still have jobs and they're still paying their mortgages. Typically, when home sales in the past have dropped due to a recession, there's also a jump in unemployment and other factors like that that cause more foreclosures and then more supply in the market. So the market is still somewhat supply constrained, but I think it's a very unique place because if we fall into a deeper recession and layoffs do increase, I mean, the housing market is at a very high risk of a pretty steep correction, especially if mortgage rates continue to go up, and especially if the Fed decides that they do want to sell MBS.
Got it.
But again, that's just my theory. I don't think anybody really knows why we have that level of decoupling.
Okay.
Another problem that we have, obviously, is that the saving rate is really low, that could impact housing down the line. Right now, jobs are plentiful. People still have jobs, but this is one of the things that you worry about, because you can see here during COVID, we had this massive increase in savings, and credit card debt, measured here in revolving debt, plunged because people actually paid off their debt. They got stimulus. They stayed home. They didn't have anything to spend it on. Then the second boom was the stimulus package and giving checks to everybody. Savings rate increased again. But then now, with inflation and everything we've seen, an increase in cost of living, savings rate is way back down to below pandemic levels, and revolving credit actually made a new high. So the consumer is in a very, I would say, fragile state if we go into a deeper recession. There's not a lot of cushion.
So what explains this re-increase in credit card debt? Because they go to these real lows and then very quickly it starts running up again. What causes that?
I would say 9% CPI, right? Your salary is just not enough to cover the daily expenses. I mean, inflation just picked up so quickly, so suddenly that if the salary is not enough, you make up for it with credit card debt. It's really not the best situation. So what is holding things up? What is holding up generally? Like what do we see that's very positive? And again, the labor market. In prior times that we had these type of economic indicators in different places, we've seen the labor market already weaker, but that's not the case now. We're still seeing 3.6% unemployment rate. Granted, employment is a lagging indicator, but it's still extremely low. And labor is still, we're seeing some layoffs, but generally speaking, nothing at the vicinity of prior recessions. And as I said, we are seeing some of a tick up in jobless claims, but comparatively, it's still relatively low. So that's one of the indicators that I'm watching very carefully to see whether or not we're going to see larger layoffs that are going to impact the broader economy. We're also seeing earnings holding up relatively well. Earnings revisions are holding up both in the S&P and European stocks, etc. Up here. Emerging markets earning a revision, interestingly enough, are collapsing. And a lot of it has to do with the US dollar being so strong. So if you recall back to one of the calls we've done about the dollar in emerging markets, there's a very strong inverse correlation between how strong the dollar is and the performance of emerging markets.
Well, this makes sense because if I am one of these South American countries that takes a loan in US dollars and my home currency is all of a sudden getting weaker versus dollar, it just requires more of my home currency to pay those dollars off. So that kind of explains it, right?
Yep, it's basically a margin call. You have to basically pay more in order to serve the same amount of debt. So let's talk about the recession watch. Some of the things we're looking at when it comes down to this recession expectation. Again, the drying demand, asset price falling, reduced consumption, and then you get the energy and commodity price collapse. That's been the case in the past. So even though earnings revisions themselves are still up, the sentiment is falling. And in the past, this was a leading indicator to the earnings per share themselves. And in this chart, you can actually see the corporate sentiment followed by quarterly earnings per share year over year, lagged by a quarter. And there's been a very strong correlation between what earnings sentiment is on a corporate side and eventually the performance of earnings. So this projects that earnings will decelerate quite a bit going into the future. Now, if earnings decelerate, that would eventually leak into the labor market. Because if you're a company and you're a C-level executive at a company, S&P 500 company, and your earnings are starting to fall, what do you typically do first?
You cut and you right size.
You cut. And when you cut, and 70% of the economy is based on consumption, that actually creates a negative feedback loop, because that means that the same people you fire are going to buy less of your products, which is going to make your earnings fall even more.
But wouldn't also a negative expected earnings also impact discounted cash flow models where people are projecting forward earnings and also just say, hey, markets are overvalued, stocks are overvalued, let's slash price estimates?
That is correct. Typically, that comes at the end of a bear market when that happens. So it's actually funny enough, but when that happens, it's usually time to buy, because it means that all these things have already been priced in. Historically speaking, we're not there yet, which tells me that we're probably not yet at the bottom of this move. But that's not to mean that we can't have some pretty big rallies in between. So it's really a more tactical, nimble time where controlling risk is essential. And that's how we've led the portfolio in Equi. We've been fairly cautious and risk averse in this type of environment. So let's talk about the 2 and 20 yield curve. We've talked about this before, where you have the 2-year treasury and then you have the 10-year treasury. And in a normal time, you would expect that the 10-year treasury is going to yield more, right? Because you're holding that bond for a much longer period of time, which means you're going to want to get more compensated for holding it into a longer period of time. And at some points in time, that yield curve inverts, where a 2-year treasury may yield higher than what a 10-year treasury would. And why would that happen? It happens.
Why would a 2-year yield higher than a 10?
Correct.
Well, my guess is because the sophisticated capital is all rotating into the long bond. So if they're all buying the long bond, they're saying we're just going to sit it out for these coming years, and we are going to depress the yields of that print. And maybe that would allow the shorter bond to have more yield associated with it.
Sure, but why are they deciding to buy the long bond? The reason they're buying the long bond is because they're anticipating a recession.
And then if there is a recession in the future, they cut rates. They are thinking that I'm going to lock in these higher interest rates now versus what the greater market is going to yield at that time.
That's exactly how that plays out. What's interesting too is it becomes almost a self-fulfilling prophecy, because what happens to the banking system during a yield curve inversion? The bank business is to lend money at what rate?
They would at the short term end of the spectrum, right?
No, they lend at the long term. So imagine most of the business is mortgages, right? So they lend mortgages, and they do 20-year loan, 30-year loan, but then they borrow at the short end.
So they are okay. So they're borrowing at a higher rate. So does that compress their ability to make money then?
It totally compresses their ability to make money, and then hurts banking profitability. And then the financial system becomes more conservative and more restrictive, and less loans are being made. And that even contributes to the recession. So it's almost like a self-fulfilling prophecy, where when you get the yield curve inversion, you're already seeing damage in the banking system as well. So it's a very interesting thing to see. So in the past, yield curve inversions have almost always led to recessions. You've seen that here in 1980s, early 80s, early 90s. Usually within 12 to 24 months, you get a recession.
And for the record, all the gray periods on here
are recession
areas are recessionary periods.
Correct. And then early 2000, 2006, and then right before COVID, actually, and then right now. We are actually the most inverted since 2000. And what's interesting as an observation is that a yield curve inversion doesn't necessarily mean equities are going to fall right away, or you're going to have a recession right away. It's actually when it goes back into normal after the inversion that you get the recession, typically. So right now, the Fed is hiking on the short end. The long end is relatively lower, and it's almost as the market's expecting this recession. The timing is really what's in question. And obviously we have inflation to watch and all those kind of things. But what I believe all this is doing is it is in fact dramatically increasing the likelihood of a Fed pivot. The Fed is so far talking the game that they're talking, but inflation expectations are falling. The yield curve is heavily inverted. We're seeing some signs that the economy is a major slowdown. And when I say a Fed pivot, that doesn't mean the Fed's going to say, okay, we're lowering interest rates immediately or doing anything like that. But it means that they may talk less of a tough game, and they may ease off or walk back some of the things they've done. I suspect QT would be the first one, given what we talked about with the MBS market, and they may address this. So then the question is, when do they address this? This is pure speculation, of course, but every summer in August, this year's between August 25th and 27th, there's a summit of all the heads of the central bank in the entire world in Jackson Hole, Wyoming, where everybody that's anybody in the world of central banking goes to this conference when they decide the fate of the world in closed doors. In the past, when there were major Fed pivots, it was typically announced in Jackson Hole.
So you're saying we're going to have to get a camper van. We're going to have to start right here in Austin, Texas, and we're going to have to do a multi-day drive so that we can find out exactly what's going to happen there and report on it for everybody here, right?
I think the security is going to prevent us from doing so, but
okay.
I'd be watching any statement out of Jackson Hole to see if the Fed is in fact going to walk back some of the things they've done this year. I think the data supports that they will do something like that. If they don't, I think there could be a pretty substantial market disappointment. But in the meantime, between now and then, markets could very well be volatile. We could see a little bit of a scary move down, or we can see still a little bit of a move up after this rally. I wouldn't be surprised if we see a little move down to correct some of it and then a move back up again, but that's completely TBD. What is interesting though, is if we're not in a recession just yet, I know we had 2 quarters of declining GDP, but that was that's a technical recession. The next GDP print could be still positive. And what's interesting is that, yes, we do get a recession after the 210 gets inverted. That is true. And we do get falling equity markets. However, there is a time window between the Fed pivot itself and when the reality of the recession hits and rates start going down, that the markets actually move up and typically move up quite aggressively. Why? Because the perception is that there's a Fed pivot, everything is going to be fine, we're going to avoid the recession. But then it typically doesn't happen because the economy has a lag effect and then markets fall afterwards. Every time in the last 4 cycles, when something like this happened, we had a massive rally in equities for a short period of time before they rolled over again. So here's in 19, the Fed paused, you had the 39% move up. In 2006 to 7, the Fed paused interest rates, you had a 25% move up before it rolled over and Fed starts cutting, and of course you get the recession. In 2000, you only had a 9% move, and it only lasted for about a few months. And then in 89, that was a 27% move. So again, one of the things I'd be watching for, if we get this kind of Fed pivot, we're not in a recession yet, markets could move up quite a bit before they roll over again. That's really it for today.
Cool. Well, Itay, you did fantastic. Thank you so much. We appreciate it. And thank you everybody for tuning in. We'll be back next month with a lot more good content.